Hello everyone. I am Hayama. Thank you all for taking the time today for our financial results briefing. Now, I would like to explain the financial results for the second quarter of the fiscal year ending March 2025. As you can see, today's agenda covers three main topics. First, I'll discuss some key financial performance highlights for the first half of this fiscal year ending March 31st, 2025. When comparing the financial results from the first half of the fiscal year, which concludes in March 2025, to the previous year, there was a decrease in sales alongside an increase in profit. Net sales decreased, partly due to a reduction in system development projects in the financial IT service business. However, operating income saw an improvement due to the absence of one-time factors, such as the previous year's provision for loss on orders received in the retail and IT service business. Additionally, as we began investing in the DNX Ventures Fund for US in June 2024, we incurred management expenses related to this investment, which contributed to non-operating expenses. On the other hand, we also recognized interest income and penalty income from the early termination of certain customer services, which bolstered our non-operating income. This is a breakdown of net sales and operating income by segment. I will explain the details on the next slide. Net sales increased by 162 million yen in the retail and IT service business, but decreased by 101 million yen, 121 million yen, and 346 million yen in the wholefoot business, data platform business, and financial IT service business, respectively. As a result, net sales decreased by 406 million yen. Operating income increased by 1,235 million yen and 76 million yen, respectively, in the retail and IT services business and the wholefoot business. Still, it decreased by 323 million yen and 179 million yen, respectively, in the data platform business and the financial IT service business. As a result, operating income increased by 809 million yen. This is the consolidated balance sheet. Assets saw a decline of 1,260 million yen, primarily due to a reduction in cash and deposits. Non-current assets increased, mainly due to a rise in investment securities. On the liabilities side, there was a decrease of 1,028 million yen, driven by reduced provisions, including losses on orders received. Net assets decreased by 231 million yen, impacted by the allocation of funds for dividends from retained earnings, while first half net income attributable to owners of parent was recorded. Next, I would like to explain how we achieve management that is conscious of capital costs and stock prices. We are working to ensure that management is fully conscious of capital costs and capital profitability, with the intention of achieving medium to long-term enhancement of corporate value and sustainable growth as required by the stock market. Our cost of equity is estimated at approximately 4% based on CAPM. As a benchmark, we aim to achieve an ROE of 20% as a medium to long-term target, considering our peers' ROE levels. However, we are transitioning our business model from contract-based development to product service provision, and are investing in product service development and our workforce to support this transition. Consequently, our ROE has yet to reach our target level. To address this, we will strive to generate profits and increase corporate value by implementing our plan. Additionally, we distribute dividends to shareholders based on the DOE standard. This approach ensures that we provide stable dividends amid short-term fluctuations in earnings. Here are the management indicators we focus on. ROE is 10.5% for the full-year forecast, compared to the medium to long-term target of 20%. TSR is 133.6% at the end of September 2024. DOE is 10.2% compared to the target of 10%. Equity ratio is 65.3% at the end of September 2024. This is the TSR benchmark. The evaluation period began at the end of the fiscal year 2020, and our performance is being compared against approximately 300 companies in the GICS industry group. As you can see, our TSR falls below the industry average. One contributing factor is that our share price was relatively high at the end of March 2020, the base date for the evaluation period. However, we believe the primary reason for this underperformance is the decline in our EPS, largely due to the costs associated with developing products like Hull-Foot Square. This has negatively impacted both our share price and TSR. We remain committed to engaging in constructive dialogue with our shareholders and investors. We greatly value the dialogue we have with our shareholders and investors. Your feedback during IR meetings and other events is sincerely appreciated, and we will continue to incorporate it into our management practices. Today, we'd like to share some common questions that often arise in discussions with our shareholders and investors and our responses. Although we won't read through each question during this presentation, we hope you find this information helpful. Next, we will discuss our strategy for the current fiscal year and provide an update on our ongoing efforts. Our business strategy is established around the 4 shifts shown here. We are transforming our business structure from a contract development model to a product service provision model. To support this transformation, we will leverage the experience and knowledge we gain from developing and operating mission-critical systems, applying it to our data linkage business, where we offer proprietary products and services. In an IT company like ours, the key to achieving the business shift lies in our human resources. We will promote a technological shift and a human resources shift through the exploration and development of technologies. Moreover, to drive our business shift effectively, we recognize the importance of making quick decisions with a sense of urgency. For this reason, we are also implementing an organizational shift, which involves restructuring our organization from a business-based framework to a function-based one while transferring authority to executive leaders. First, I'd like to talk about our business and technological shifts. As I mentioned earlier, we are transitioning from a contract development to a product service model. The dark blue you see here represents the sales ratio for the data linkage business, which provides proprietary products and services. Back in the fiscal year 2016, this ratio was around 24%, making up about a quarter of our total sales. Fast forward to the current period, the first half of the fiscal year ending March 2025. This figure has risen to approximately 52%, which amounts to more than half of our total sales. We are positioning ourselves to become a highly profitable company by increasing this ratio. Next, I'd like to provide an overview of the sales performance for Hull-Foot and DataSpider, which are currently our primary revenue drivers. Sales from these products and services are primarily captured within the Hull-Foot business. Notably, the recurring sales ratio for Hull-Foot stands at 65.8%. The recurring sales help stabilize our earnings base. We've seen an increase of 616 support service contracts for Hull-Foot compared to the end of the previous fiscal year, while DataSpider experienced a slight decline with 5 fewer contracts. The number of new shipments of licenses for Hull-Foot and DataSpider increased by 279 and 23, respectively, demonstrating the continued growth. We are positioning Hull-Foot Square as a key growth driver for our data linkage business and are focusing on its expansion. At our largest annual event, Hull-Foot Technology Days 2024, the companies shown here presented a case study on the implementation of Hull-Foot Square. They have introduced Hull-Foot Square as a platform for linking data scattered across the organization with cloud-based data and enhancing overall data utilization. Since its launch in 2023, Hulfort Square has been steadily adopted, particularly by enterprise companies, and we will continue our efforts to broaden its application further. Hulfort Square is also being rolled out in North America, Europe, and the ASEAN region. The adoption of cloud data is significantly more advanced, particularly in North America and Europe, several years ahead of Japan. By participating in events in these regions, we aim to enhance our brand recognition while keeping up with the latest global trends and demands. In recent years, we have showcased our solutions at AWS reInvent 2023 and AWS Summit 2024. And most recently, we exhibited at Dreamforce 2024, organized by Salesforce in San Francisco last month. Our team included not only employees from our overseas subsidiaries, but also colleagues from Japan, and during the three-day event, we connected with over 600 attendees. I was there as well and could feel the excitement in the air. We will continue to focus on technology and global engagement. In Japan, we are collaborating with many sales partners. We have already established partnerships with 16 companies. Just as important as sales partners are alliance partners. Alliance partners provide services in various fields and operations. Take Arsuene Inc., shown in the top left, for instance. They offer cloud solutions for visualizing and reducing CO2 emissions. Accurately calculating these emissions requires seamless data linkage with various internal systems. That's where Hulfort Square comes in. It facilitates the necessary data linkage by converting and matching information to the format required by Arsuene, all without coding. This empowers customers to visualize their CO2 emissions quickly and make swift decisions based on that data. By integrating multiple cloud services through Hulfort Square like this, we consistently provide robust support for effective data linkage and utilization for our clients. Hulfort Square is continuously being improved with new features released every few months. One of the key advantages of cloud services is their ability to be updated at any time. We remain committed to enhancing the product's functionality while keeping the updates smooth and steady. Next, we have Hulfort 10 on the horizon. It has been 10 years since Hulfort 8 was released in 2014. With Hulfort 10, users can expect new features, including cloud-native capabilities, internet transfer options, and enhanced speed and security, featured in the Container Services version released earlier this February. Stay tuned for the official announcement in December. Data Spider Savista is set to launch version 4.5, the culmination of version 4, on November 6th. Please look forward to it, as the upcoming version aims to improve operational functions and expand connection destinations. We are committed to enhancing our product and service offerings. For this purpose, in June, we invested in DNX Ventures Fund 4 US, a Japanese venture capital fund focused on startups in the US, Europe, and beyond. These investees possess deep expertise in areas such as cloud computing, AI, and data utilization. Last month, I had the opportunity to visit Silicon Valley and meet with several local startups. By engaging directly with these emerging companies, we aim to integrate the latest trends and technologies into our offerings, further strengthening our products and services. It will also promote the development and growth of our employees. We would like to share an overview of our recruitment activities and training initiatives. In terms of recruitment, we made steady progress in the tight engineering market, successfully achieving 100% of our recruitment plan by the end of the first half period. We expect 90 new graduates to join us in April next year and have also brought on board 30 mid-career professionals. On the training front, we have strengthened our career development support system by introducing a new career advisor function. We have focused on the cloud computing and AI domains to enhance our technological capabilities, which align well with data linkage. We have been promoting projects to train top engineers in the cloud domain and specialized training programs for AWS and Azure. These initiatives extend beyond training. We also establish virtual organizations throughout the company to boost our technological capabilities. It's quite remarkable for a company of our size, but we have been recognized with awards for our expertise and proven track record across all three major cloud services: Google Cloud, Microsoft Azure, and Amazon Web Services. While many IT companies focus on one of the three primary clouds to strengthen their cloud skills, the nature of our products and services necessitates the connection to various products, allowing us to excel in all three. Notably, one of our employees has been honored as an ambassador in the AWS Award Program, which selects only 300 individuals globally. We are committed to further enhancing our technical skills and training, leveraging these awards to drive our growth and capability. To enhance our employees' working environment and overall performance, we implement several initiatives focused on improving sleep and promoting flexible work arrangements, regardless of location. One of our key initiatives involves using electroencephalogram devices to assess our employees' sleep patterns. If any issues are detected, the company will subsidize part of the costs associated with improving their sleep quality. Given the nature of work in IT companies, many employees spend long hours sitting in front of computer screens. As a result, many of them need better sleep quality. Our sleep improvement initiatives have garnered considerable attention from the wider community, and recently, we were featured in an interview with TV Tokyo on their World Business Satellite program. The female employee on the right is one of our remote workers. Our remote working system allows employees to work from anywhere in Japan without needing to be in the office. As of the end of September 2024, 15 people across the country are taking advantage of this arrangement. This year, we also joined the Nikkei Women Empowerment Project for the first time, with the goal of fostering a better future. This initiative, organized by Nikkei Incorporated and Nikkei Business Publications Incorporated, is designed for companies striving to achieve gender equality in management. I recently attended the President's meeting associated with this project, where I gained insights into the initiatives of other companies and shared our actions and challenges. While our company's ratios of female employees and female managers exceed the industry average, we acknowledge that there is still significant room for improvement. For this reason, we view our participation in this project as an opportunity to accelerate the elimination of the gender gap, both within our organization and beyond. As part of our efforts to focus on the material issues of the environment, we have implemented a virtual PPA at our data center. This initiative ensures that all the electricity used by our company will come from renewable energy by the fiscal year 2026. Additionally, the building of our head office has already transitioned to renewable energy since the fiscal year 2022. By leveraging the virtual PPA at our data center, which accounts for approximately 90% of our in-house power consumption, we are working toward achieving 100% renewable energy in practice. We also commit to donating 1% of our operating income to support non-profit organizations that align with our mission and materiality. Instead of simply making donations and moving on, we take the time to deepen our understanding of these issues and foster relationships built on trust. We accomplish this by providing opportunities for insightful experts to speak to our employees and visiting the facilities we support with our contributions. In August of this year, we participated in the Nikkei IR and Individual Investor Fair, one of Japan's largest investor relations events. During the event, which was conducted both in person and online, I presented to retail investors about trends in the IT industry and our company's ongoing initiatives. Finally, I will provide an overview of the full-year earnings forecast for the fiscal year ending in March 2025. While sales of system development and management business for specific customers are expected to decline, net sales are expected to increase, driven by the expansion of the data linkage business. Operating and ordinary income are projected to rise, even with ongoing investments in product and service development, such as Hull-Foot Square and human capital. This growth is anticipated as one-time issues, like the order losses in the retail and IT service business that occurred in the previous year, will no longer exist. Here is the dividend policy and dividend forecast for the current fiscal year. There are no significant changes to report. For the fiscal year ending in March 2025, the planned dividend is 90 yen per share and an first half dividend of 45 yen per share. That concludes my presentation. Thank you for your attention.